Hey there! Welcome to another Dividend Bear video. Today we have something amazing to share with you. Here are 10% stocks that never cut their dividends. Be sure to watch until the end of the video. The world experienced a global epidemic more than 2 years ago with the existence of the coronavirus disease, a disease that killed millions of people worldwide. Dealing with the pandemic did not go easily as people's lives were in danger. The pandemic did not stop there, and in fact, it has not ended yet because there are still cases of the said disease. Pre- and post-pandemic were followed by different global issues. Now, after more than 2 years, everything seems to be going back to normal. People can now go to outside, work in their offices, and businesses and establishments are now slowly operating. For some, they call this the new normal. It is good to see that everything is slowly going back to normal all over the globe. But of course, there is still this one serious issue that we are facing: inflation. Inflation being a global issue is definitely a burden to people. As what we can see in the news reports of the continuous increase in prices of goods like food, supply, fuel, transportation, and more, the United States, as one of the first world countries, is also experiencing a spike in inflation. According to U.S. Labor Department data published on September 13, the annual inflation rate in the U.S. eased for a second straight month to 8.3% in August of 2022, the lowest in 4 months, from 8.5% in July. The next inflation update is scheduled for release on October 13, which will provide the rate of inflation over the 12 months that ended September 2022. With that being said, the U.S. Federal Reserve will continue raising its interest rates in the hopes of battling inflation of about 8.3%. People are now thinking of ways and other streams of income with this inevitable existence of inflation. Investing in stocks is one of the most popular passive income options. Investing in stocks during economic conditions is very crucial, so it is very important to understand every bit of it. Stocks are one of the riskiest investments because there are no guarantees of profits when you buy a stock. As the saying goes, invest only what you can afford to lose. And in this video, we are going to talk about the 3 stocks that perform really well under harsh economic conditions by not lowering their dividend payouts. But what does it mean to not lower the dividend payout on stocks? Well, in stocks, a dividend is the distribution of a company's earnings to its shareholders and is determined by the company's board of directors. A low dividend payout is when a company keeps the majority of its profits and reinvests them in the business and then gives out the rest as dividends. The 3 stocks that we will talk about in this video pay around 10% in dividends, which can help to offset the inflation expenses. Number 1 on the list is PennantPark Floating Rate Capital Ltd. It is a company that primarily provides closed-end, externally managed, non-diversified investments. PFLT invests in middle-market companies primarily in the United States and to a lesser extent in non-United States companies. They have proven management teams, competitive market positions, strong cash flow, growth potential, and viable exit strategies. PFLT's investment company objective is to generate both current income and capital appreciation while seeking to preserve capital. They are also seeking to achieve one of their investment objectives by investing in loans bearing variable rates of interest or floating rate loans. The company generally expects that at least 80% of the value of its net assets, plus any borrowings for investment purposes, will be invested in floating rate loans and other investments bearing a variable rate of interest. The company holds their investment in the floating rate loans for about 3 to 10 years to ensure the repayment of the dividend payout. PennantPark pays a monthly distribution of $0.095 per share, which now shows a very attractive annualized dividend yield of 9.4%. Investors receive their dividends more frequently as they make monthly dividend payments. Companies in need of capital will be more likely to take the variable loans that PennantPark Floating Rate Capital Ltd offers in order to stay afloat. 30% of the company's fund assets are in non-qualifying assets, such as investments in public companies with securities that are not thinly traded or whose market cap is less than $250 million. Securities of middle market companies outside the United States, high-yield bonds, distressed debt, private equity, securities of public companies with non-thin trading, and investment companies as defined by the 1940 Act. The company experienced a recent recession which got them a low share of 4.86 cents, but they successfully recovered from it and are currently trading at 11.20 cents as of May 2022. Second on our list is Goldman Sachs BDC Incorporated. GSBD is a closed-end management investment company. They specialize in finance, which is focused on lending to middle-market companies. One of the company's investment objectives is to generate current income and capital appreciation primarily through direct organizations of secured debt, including first lien debt, unitranche debt, second lien debt, and mezzanine debt, as well as select equity investments. For better understanding, let us define first lien debt, second lien debt, and mezzanine. First lien debt holders are those who are being paid back before all other debt holders, including senior debt holders, while second lien debt refers to loans where a creditor's claims are subordinated to those of the creditors who hold senior debt. On the other hand, mezzanine financing is a hybrid of debt and equity financing that gives the lender the right to convert the debt to an equity interest in the company in case of default. In terms of risk, it exists between senior and debt equity. Well, now going back to GSBD, they invest in various sectors such as software, healthcare technology, diversified financial services, healthcare equipment and supplies, entertainment, and chemicals. An investment in GSBD stock means your portfolio will reap some of the rewards of these high-growth companies. Goldman Sachs BDC has a dividend yield of 8.3% and earns an A rating on Portfolio Grader. The company offers an annual dividend of 10.16% as well as lower volatility during normal economic conditions. The company also experienced a recession, and it took them a year to recover from the levels of around $20 a share. This began in March 2020 and ended in March 2021. The annual target of GSBD is currently set at 18.50 cents a share as of May 2022. Last on the list, but definitely not the least, Whitehorse Finance Incorporated, an externally managed, non-diversified, closed-end management company that has elected to be treated as a business development company under the Investment Company Act of 1940. This investment company prefers to invest in the United States and has a total of investments of between $5 million and $25 million in companies having an enterprise value of between $50 million and $350 million. They specialize in originating secured loans for middle market and growth capital industries. Unlike the GBSD, which provides mezzanine investment, WHF provides senior secured loans, which are considered to be less risky. The reason why senior secured loans are less risky is that they take precedence over other loans if the company declares bankruptcy and starts selling its assets. WHF capitalizes on the market inefficiencies and profits from the imbalance between supply and demand capital for small-cap credit markets. One of WFI's investment objectives is to generate risk-adjusted returns by originating and investing in senior secured loans, including first lien and second lien facilities, to performing lower middle market companies across a range of industries, which typically carry a floating interest rate based on a risk-free index rate such as the London Interbank Offered Rate or LIBOR. The investment companies mentioned were proven to have performed well during economic conditions. However, as they may have a good performance and feedback from others, it is still important to do your own research when considering investing in these companies. As Benjamin Franklin once said, an investment in knowledge pays the best interest. Nothing will pay off more than educating yourself first when deciding to do something. As of May 2022, the shares of the company are currently trading at 13.52 cents a share, which is equal to about 10.5% in dividend yield.